Well, everyone, welcome back to the Velocity channel. And here is another episode that is sure to gain you some knowledge in how to go towards financial freedom. Listen, I know a lot of you are concerned about the personal lines of credit. I know you're concerned about the lines of credit, the freezing, and even the taking away of these personal lines of credit. But today I'm going to address this issue and show you why you don't need to be afraid of this if you know Velocity Banking, especially if you have the automated Velocity Banking tool down pat. All right, before we go any further with this, you need to like, share, and subscribe so that a lot of your friends, a lot of your family, and a lot of your community can know this information and be safe, especially when we're going towards the times ahead. Now, look, this is the time that I've been telling you about, constantly. And this is why we must have options. I understand that a lot of us were brought up underneath the traditional banking style of doing things, how we pay the bills as soon as the income comes in, the electric bill, we got the mortgage, we got the car loan, we got all of these bills that we need to pay from our checking account, but we don't really know how to pay them in such a way that the chunking of the principal on those loans that we owe on can actually take off tons of interest. We don't know what date to pay it in. We don't know what time frame to pay it in, and that could be a challenge, right? But today we're going to solve that right now. Are you ready? Let's go ahead and put down these scenarios. I'm going to talk about the personal lines of credit, the business lines of credit, the HELOC, your checking account, your savings account, and even if you don't have a line of credit, I'm going to show you how to get rid of those loans lickety split. All right, not 10 years, right, but as little as 3 to 5 years. If we're talking about a car loan and your mortgage, that's the 30-year, right? Some of you, it's 40 years, right, and above. But I'm going to show you how to do it in as little as 5 to 10 years. Are you ready? Okay, let's go ahead and do this. Okay, so we got to give a special shout out to Lilith Grant, Anonymous. You know what I'm saying? I gave her that name because I wanted her to stay anonymous, but she tipped me off to what they're doing with these personal lines of credit because they did that to her personal line of credit, all right? And this is happening throughout the nation. And so if it comes your way, I want you to be armed to the teeth so that you can still be attacking your loans regardless of what they do, all right? So we have the personal line of credit, had the personal line of credit. The end. It's gone, right? What are we going to do now, CJ? Great. We're going to go to our IRAs. But wait a minute. What if they take that away as well? No. I'm not scared. This is going to be good news, right? Listen, you'll have the savings and the checking account for now, right? The bottom line is this. We want to take whatever is in our savings account, whatever is in our checking account, and whatever else account that you have, and make sure that that money is placed in the right location. It's all about financial allocation. And this is why. Let me just spell out the word allocation here for you. And then we're going to hop right back into our illustration, okay? But I want to kind of ease the nerves because I feel this coming from the screen, right? When you're talking about money, it doesn't really matter the tool, right, that you have, okay? It matters what you're going to do with the money that you have. And when we're talking about financial allocation, the key word in this word is this: location, all right? Now, I want you to remember that the whole time that we're talking about this, because it's going to be a very, very important element all throughout this illustration. Okay, now let's get to the numbers. So if we look at our amortization table, we'll see how that principal and interest is stacked up. And on the first month of our payment, let's say it's the $200,000 at 6%. The first month of the payment, the month will be $1,199.10 each month, right, of payment. Now that's not going to change, all right? But what does change is how much goes to the interest. Let me just illustrate here. So September, $1,000 is going to be going to the interest, And then to the principal, the rest, right? $199.10. Okay, go ahead and check my math on that. Is that correct? $1,000 going to the interest, and then the principal is $199.10. Now, what we want to do is we want to switch these numbers. Okay, now how are we going to switch these numbers? Because we want more going to the principal than we do going to interest. That's velocity banking. That's making sure that our money is used to pay down our debts and not just to pay our lenders, to pay down our debts, to pay down our debts and not just to pay our bankers, right? So we want to make sure that this is switched, right? We want 1,000 going to the principal, right? 199, or at least as little as possible going out from us. And so with that, what we do is we look over to our checking and savings account and we say, well, wait a minute, I got an extra $25,000, maybe $30,000 lying around, and even if it's not that much, this is the principal. Let's say $12,000 in the checking account. What I want to do is I want to make this work for me, because right now it's not working for me. I want to make this number work for me because right now it's not working for me. Now you may say, well, CJ, I get like 4%. Annual yield on mine. So I don't know what you're talking about. Okay, but hear me out. You're getting 4% on the $12,000 when you could be placing this $12,000 towards this number here, okay? The principal. Now the $12,000, right? Subtracted, let's subtract 200,000 minus 12,000. What is that? Let's go ahead and do it. That way I'm not pulling anything out of the hat when I show you what you should be doing or submitting to you for your consideration what you should be doing with your money, okay? So that's $188,000. Now, what is the interest feeding off of? The interest is feeding off of the principal, right? So if you were to pay $12,000 towards this number, that way the balance would not be 200,000, but the balance is now 188,000. What would your interest be then? Well, there would be more going to the principal in a magnificent fashion, might I add, versus going away from you or to the interest. You see, those that don't understand interest are bound to pay it. But those that do understand interest are bound to earn it. All right. There's nothing wrong with bondage as long as you like it. All right. Now, $1,199.10. We've divided it up. Okay. Let me put a border there. And so with that, you're making this work for you, this $12,000 here, because you've just jumped about 6 years. 5-6 years into the future. And this is why I'm talking about on one transaction. As you continue to pay that monthly payment, you're dramatically reducing the time that you're inside of that debt pledge or mortgage. Okay, that's what mortgage means. And so 188,000, would you like to know how much interest you've saved by putting the $12,000 inside of the 200,000, reducing that balance to 188,000? Would you like to know how much you saved? Let's go ahead and do it. Now I know this is going to be unbelievable, so I'm just going to go ahead and show you the numbers here. All right. When you do the $12,000 as we've discussed towards that principal, and this is just one of many that you could utilize, right? We're talking about automating your velocity banking so you don't have to do these things, right? And please let us know if you need any help with that. Look, you're jumping 64 months into the future by simply doing one move with your savings account. Now listen, can your savings account in one move give you $61,768.89 with $12,000 at 4% yield? Would you rather have the $12,000 at 4% yield, Or would you rather have your $12,000 give you over $61,000 and actually cause your mortgage to go into the time machine to jump 64 months into the future, thereby accelerating your mortgage, and you're also accelerating your equity? Which one would you like? Which one would you like, right? And that's what I want you to do. I want you to change your thinking, that it's not about the line of credit. It's not even about your IRA. It's not even about the savings or checking account. It's about allocation. You'll need help with that now. And so that's why we're here. Please schedule a call with us. Let us know, hey, I don't even need to schedule a call with you. Let me get your analysis report. I want you to do my analysis. I want you to do my numbers, and we want to see where we're at. Well, we can do that as well. All right. So just let us know. We're here for you. And remember, this doesn't only go for the mortgage. It can go for your payday loans. I saw one payday loan, 109% per year. And they just laid it out there, 109%. Perhaps I'll give you an illustration of that later on in the month, but just astronomical numbers. But guess what? Those of us who know about velocity banking, who have that automated velocity banking system, we're not worried about that, because whatever they say this interest rate is does not apply to us. We're getting over $61,000, right? By one transaction. And we know why we're getting that, because we know about interest. Finally, God bless you. Like, share, and subscribe this video all over the place so people can understand that it's not about just how much you come in with, right? But it's also where you're placing it. God bless and have a great night.